Okay, Professor Jim Schultz here from my Finance 670 students. I wanted to pick up where I left off here at part one. Part one, we covered part one of the bond valuation series. We covered a bond's timeline, and then we covered the variables that you see in a bond problem. We discussed kind of in a little bit of detail what each one of those is, and it's very, very similar to what you saw in the time value money section. So it's not too daunting at this point. Well, I wanted to kick off part two here, exactly where we left off, with bond prices and interest rates. So this topic right here, this guy that I'm going to highlight right here, that guy is very, very, very involved. And I will talk about that in great detail, and I will explain it in great depth and great detail when I see you in Finance 680. But what I want you guys to remember right now, or to understand if you haven't seen this stuff in a long time, is that bond prices and interest rates have an inverse relationship. So what that means is this: when interest rates rise, bond prices will fall. And when interest rates fall, bond prices will rise. Now, you may be asking yourself, well, why is that the case? I will explain in great detail why that is the case when I see you in Finance 680. But you're going to see this ripple throughout some of your practice problems in this section, that when interest rates change and when interest rates move up, bond prices will move down. When interest rates move down, bond prices will move up. Now, I'm referring to bonds that are currently outstanding in the marketplace. So, like for example, Coke issues a bond 1 year ago, right? And let's say that this bond has 10 years left until maturity. If interest rates change today, that's going to cause the price of that bond that's currently on the market to change. It's not going to impact the price of any bonds that have yet to be issued. Those are still going to be issued at par value, or $1,000. Okay, so if you haven't seen this stuff in a while and you're kind of rusty on your finance stuff, just understand that when interest rates change, the prices of bonds that are currently on the marketplace will change, and they will move in an inverse direction. Okay, if you can latch onto that, even just at a very basic level, that's really good at this point. I do not expect you to necessarily understand why that is so, because I'm going to teach you exactly why that is so in Finance 680. Again, the purpose of this entire class is really more mechanical and quantitative in nature. It's a lot less about intuition and understanding, two topics that I focus heavily on in Finance 680. Okay, now when you own a bond, there are only two ways that you can make money from that investment. And these are the only two ways that you can make money from that investment. You can either make money from your coupon payments, which should seem pretty obvious, right? You buy a bond from Coke, or Coke issues a bond, you scoop it up at the date of issue, and then you just sit on that guy for 2 years, 3 years, 5 years, whatever, and just collect your coupon payments. That's one way that you can make money. Well, there's actually a second way that you can make money. You can make money from the price change of your bond. So maybe you buy a bond for $1,000 when it is first issued. And then while you're holding that bond, interest rates happen to go down. So what's going to happen to the price of your bond? It's going to go up. It's going to be worth more than $1,000. So what could you do? You could sell that bond when the price rose, and you would have a gain right there. That is another way that you can make money from owning a bond, through its price change. Here's actually a second example of a price change. So Pepsi issues a bond 2 years ago. That bond is issued at $1,000, which they almost always are, right? Unless you're dealing with zero coupon bonds or kind of uncommon bonds, they're almost always issued at par. And we'll talk about that in Finance 680. But let's just assume that they're issued at par. Pepsi issues a bond 2 years ago at par. Over the course of the last 2 years, let's say that interest rates have risen. So what does that mean? That means the price of that bond will have fallen. So now that bond might be worth, let's say, $900. You could come onto the marketplace and you could buy that bond today for $900. Now what's going to happen is, over time, as that bond approaches maturity, its price is going to gravitate towards $1,000. Because when that bond matures, it has to be worth $1,000. Because if you remember from part one, if I send the company $1,000 at issue, I need to get that $1,000 back when the bond finally matures. And so if the price over the life of a bond, if its price deviates drastically from 1,000, it has to then gravitate towards 1,000 as it gets closer to maturity. So in other words, if a bond is going along and its price jumps up, it's going to fall over time to bring it back to 1,000. If a bond is going along and its price falls down, it's going to increase over time to bring it back to 1,000. So a second way that you can make money from owning a bond in this price change category is you could buy a discount bond. It's called a bond selling for less than 1,000, and you could simply let its price increase over time back to 1,000 when it matures, and you could collect that capital gain, or that capital gain yield, which is what CGY stands for. So these are the two ways that you can make money from owning a bond. You can either make money through the coupon payments, or you can make money through the price change. These two components together add up to your yield to maturity, which is what we talked about in the first part of this series. Remember, this is your total return from owning the bond, right? Well, this just tells me or shows me that my total return breaks down into two separate pieces. One piece from the coupons and one piece from the price change. The current yield is found by taking the annual coupon in dollars, not percentage, divided by the current price. You'll see this in the practice problems. But the current yield, this is a percentage. It is found by simply taking the annual coupon divided by the current price. The capital gains yield is found by simply taking the new price minus the old price divided by the old price. Now, let me explain that a little bit more. When you are looking at a capital gains yield in the financial world, you are almost always, like 99 times out of 100, you want to know what the capital gains yield is going to be for the next 12-month period, for the next year. Looking out into the future, 1 year, what is my capital gains yield going to be? What is my current yield going to be? You're almost always looking out, forecasting forward by 1 year. So if I'm trying to solve for my capital gains yield, I need to know my new price, which will be the price of the bond at the end of the year, minus my old price, which would be the price of the bond today, divided by the old price, which is the price of the bond today. That is how you find the capital gains yield of a bond. And actually, this formula right here, as we'll see when we do the stock valuation section next, that formula actually works in every single context in the financial world. It doesn't matter whether you're talking about bonds or stocks or houses or gold or oil. It makes no difference. Whenever you're trying to measure the percentage price change that you're going to realize from an investment, you can always take the new price minus the old price divided by the old price. So that is it for the bond valuation basics. Much like I did with the time value money section, I am also going to do a video walking through a couple practice problems. So that's it. That closes out the two-part series.